Welcome to Griffonomics.
Glad to be here for this one.
So imagine growing your business by over $500 million in just 90 days.
Right. Just an absolute massive surge.
You shatter your own revenue records, you completely crush Wall Street's earnings estimates, and to reward you, the market brutally tanks your stock to a 52-week low.
Down to, what, $57.46?
Exactly. 57.46. I mean, if you were listening to this deep dive right now and looking at your own portfolio, you are probably staring at your dashboard in just complete disbelief.
It's completely counterintuitive.
It defies the basic physics of the financial markets, right? Where good news is supposed to mean the ticker flashes green.
It's the ultimate growth paradox because, we are looking at a situation where the headline numbers are screaming absolute victory.
Right.
But the underlying mechanics are sending institutional investors running for the exits.
So our mission today is to really tear down this extensive strategic report and investment roadmap for Brown & Brown.
Ticker symbol BRO on the New York Stock Exchange.
Right, BRO. And founded in 1939, so this isn't some, volatile tech startup. It is a legacy insurance intermediary.
Yeah, an 85-year-old legacy firm.
But they are currently navigating what the report calls a massive strategic inflection point. They are attempting to transition from a standard traditional insurance broker into this high-margin, tech-enabled specialty powerhouse.
And that transition is precisely what is causing all this friction with the stock price.
Because the market is looking at their first quarter of 2026.
Exactly. And the headline there is $1.9 billion in revenue.
Which is huge.
It is a massive 35.4% year-over-year surge. But sophisticated investors, they are looking right past that headline.
Yeah, they are digging into the weeds.
They are. And they are seeing three massive red flags that we really need to dissect today.
Okay, lay them out.
First, core organic growth completely stalled at 0%.
Wow.
Zero. Flat zero. Second, they are sitting on a mountain of debt from a multi-billion-dollar acquisition.
Right, the Accession deal.
Yes. And third, there is a literal courtroom-level employee poaching scandal that is threatening the very fabric of their corporate culture.
So on one side of the ledger, you have nearly $2 billion in 90 days. And on the other, you have stalled core growth, heavy debt, and rivals literally stealing your talent.
It makes that $57 share price start to make a twisted kind of sense.
It really does. But if we are going to understand why management thinks Wall Street is dead wrong...
Because they definitely think Wall Street is wrong.
Oh, absolutely.
Yeah.
They are actually betting the farm that the stock is severely underpriced. But to understand that, we have to start with how they actually make their money.
Right. The core business model.
Because when I hear the word insurance, I immediately think of underwriting risk. I mean, I think of the carrier holding the bag when a Category 5 hurricane flattens a coastline.
Which is honestly the biggest misconception about the brokerage industry.
Really?
Yeah, because Brown & Brown operates on an intermediary model. They are the agent. They are the broker.
So they aren't the ones writing the actual checks when a disaster hits.
Exactly. Their primary revenue engine is built entirely on earning commissions and fees for placing policies. They do not assume the direct underwriting risk.
So when that hurricane hits...
The giant carriers, the ones collecting the premiums and holding those massive cash reserves, they're the ones writing the devastating claims checks.
Wow, okay.
Brown & Brown simply arranged the marriage between the client needing coverage and the carrier providing it.
I look at this kind of like a casino.
Oh, that's a good analogy.
Right. If you are gambling at the tables, you might win big, but you're carrying the risk of going totally bankrupt.
Right. A bad run of cards wipes you out.
The insurance carriers are at the tables. But Brown & Brown is the house. Actually, no, they are the dealer.
Yes, the dealer.
They take a rake on every single hand played, regardless of who wins or loses the hand. As long as the game keeps going, as long as premiums are being paid, they collect their commission.
That dealer analogy captures the essence of what we call their non-underwriting moat.
Non-underwriting moat. I like that.
By insulating themselves from the actual claims payouts, they generate this incredibly consistent high-margin cash flow.
Because they don't have surprise multi-million-dollar losses.
Precisely. Their expenses are generally just limited to salaries, real estate, and technology. They don't have to lock up billions of dollars in regulatory capital just in case a disaster strikes.
Wait, but I was looking through the sources, and there are a couple of specific exceptions where they actually do touch the underwriting side.
There are a few, yeah.
There is something called WNFIC, and then a whole section on captive insurance. So if their whole moat is avoiding risk, why are they dabbling in it?
Because they found a way to participate in the upside of underwriting while almost entirely capping the downside.
Okay, how does that work? Let's look at WNFIC first.
So WNFIC stands for Wright National Flood Insurance Company.
Right?
They are what is known as a write-your-own flood insurance carrier. They're technically issuing the policies, but the underlying risk is written pursuant to the National Flood Insurance Program, which is administered by FEMA.
Ah, okay. So they are doing the paperwork, but the federal government is actually absorbing the risk of the flood.
Exactly. They are basically acting as a highly paid administrative arm for FEMA.
That is a sweet gig.
It really is. They collect processing fees and administrative revenue, but if a city floods, the federal government's balance sheet takes the hit, not Brown and Brown.
What about policies that fall outside of FEMA's limits?
For the excess flood policies they write, they purchase massive reinsurance in the private market, so they cede the risk away immediately.
Smart. So what about the captive insurance facilities then?
Right.
The report mentions quota share and excess of long captives. Those sound incredibly complex, but from what I gather, a captive is essentially an insurance company created by a non-insurance company to insure its own risks. Right?
That's a great summary, yeah.
How does Brown & Brown use them without blowing up their non-underwriting mode?
Well, they use highly structured financial instruments to strictly limit their exposure.
Okay.
When they participate in a captive, which allows them to share in the actual underwriting profits if a pool of policies performs well, they use intense cross-collateralization.
Meaning what exactly?
They might require letters of credit or trust accounts fully funded by the other participants in the captive. And then on top of that, they buy reinsurance to cap any catastrophic losses.
Wow. So if the policies are profitable, Brown & Brown gets a cut of the underwriting profit on top of their standard broker commission.
Yes. And if the policies turn sour, the collateral and the reinsurance absorb the shock, keeping Brown & Brown's core earnings completely protected.
So even when they step outside the moat, they are wearing like a life jacket, a parachute, and a helmet.
Exactly. They don't take unhedged bets.
That makes a lot of sense. So let's look at how this machine is actually organized. Because they just ripped the company down to the studs and rebuilt it.
They did a major structural realignment.
In the third quarter of 2025, they went from 3 business segments down to 2, retail and specialty distribution.
Right. And the retail segment is what you traditionally picture when you think of commercial insurance brokering.
Like local businesses.
Yeah. They are providing property, casualty, and employee benefits to middle-market businesses and public entities like municipalities.
Yep.
They also operate an F&I division inside of retail.
F&I meaning finance and insurance.
Correct. That provides dealer services for the automotive and recreational vehicle markets.
But the strategy shift is all about that second segment, right? Specialty distribution.
Absolutely.
This seems to be the engine of the entire transition.
They took their legacy programs business and merged it with their wholesale brokerage business. And inside this new specialty segment, you have 3 massive pillars.
Okay, let's break those down.
First, Arrowhead programs. They act as a managing general underwriter. They create hyper-niche, highly specialized insurance programs for specific industries and then find carriers to back them.
Got it. And the second?
Second, you have Bridge Specialty Group, which is their wholesale access point.
Wholesale access meaning they act as the broker for other brokers.
Yes, exactly.
Like if a small-town agent has a client that, I don't know, builds skyscrapers, they have no idea how to insure that, they go to Bridge Specialty.
That is precisely it. Bridge gives them access to the hard-to-place markets, like Lloyd's of London.
Oh, okay. And the third pillar?
The third pillar is Arrowhead Specialty, which is the division handling those complex captives, reinsurance, and affinity programs we just discussed.
Okay, so I want to focus on a statistic from the retail side that completely shattered my perception of this company.
Which one?
When I hear retail, I think of volume. I think of millions of small personal auto policies or like Main Street mom-and-pop business policies.
Right, the traditional Main Street agent.
But the sources show that policies generating under $25,000 in premium make up only 1 to 2% of Brown & Brown's total retail revenues.
It's astonishing, isn't it?
They are essentially ignoring the small stuff completely.
That is a fundamental, deeply defensive strategy. A $25,000 premium threshold means you are dealing with significant commercial operations.
So not a local bakery?
No. Maybe a mid-sized manufacturing plant, a regional trucking fleet, or a large medical practice. The strategy is to intentionally hunt complexity.
Because complexity is the only thing an algorithm can't easily replace, right?
Exactly.
If I need a basic personal auto policy, I can download an app, punch in my VIN number, and have a policy in 3 minutes.
And that is an insurtech company directly cutting out the broker. Disintermediation.
But if I am trying to insure a fleet of autonomous delivery drones operating in 3 different states...
An app is going to have a panic attack trying to underwrite that.
Right. A standardized risk is vulnerable to automation. A complex risk requires a consultant.
The CEO, Powell Brown, has a brilliant philosophy on this. He says, AI disintermediates tasks, not trust.
Disintermediates tasks, not trust. That's powerful.
When a corporation is spending hundreds of thousands of dollars on a multi-layered liability program, they require a human expert. They need someone to negotiate the terms, structure the deductibles, and most importantly, advocate for them during a complex claim.
So by abandoning the sub-$25,000 premium market, Brown & Brown is building a fortress against cheap, direct-to-consumer digital competitors.
They are making themselves indispensable.
But to live in that fortress, to dominate the complex risk market, you can't just be a charismatic local agent anymore. You need immense scale.
You do. You need global market access and hyper-specialized industry knowledge.
And that realization is what triggered the massive $9.6 billion elephant in the room.
The Accession Risk Management Group acquisition.
Yes.
Completed in August of 2025, this was the largest transaction in the company's 85-year history.
It added over 5,500 teammates in a single stroke.
Just a monumental integration challenge.
To contextualize how huge this is for you listening, Brown & Brown's Q1 2026 revenue puts them at an annualized run rate of just over $7 billion. Management has openly stated an intermediate goal of hitting $8 billion in annual revenue. The Accession deal is the rocket fuel meant to blast them past that milestone.
But absorbing 5,500 people is an operational nightmare.
I can't even imagine. The report highlights a massive cultural and operational clash regarding sales models.
Yes, the regional versus local dynamic.
Right. Accession operated on a regional sales model, while legacy Brown & Brown relied on a local model. Unpack what that clash actually looks like on the ground.
Let's visualize it. The legacy Brown & Brown local model is deeply entrepreneurial. It's geographically anchored.
Okay.
Imagine a Brown & Brown office leader in Tampa, Florida. They run that office almost like an independent franchise. They know the local mayor, they know the local real estate developers.
So they are deeply ingrained in the community.
Exactly. And their goal is to capture as much business within a 50-mile radius as possible, regardless of the industry. They might insure a hospital, a construction firm, and a tech startup, all because of local relationships.
A very boots-on-the-ground, relationship-heavy approach.
Accession, however, utilized a regional model. This is much more centralized and industry-focused.
How so?
Instead of relying purely on a Tampa office to insure a Tampa hospital, Accession might have a dedicated healthcare practice group that handles hospital accounts across the entire Southeast region.
I see.
The regional expert flies in, pitches the highly specialized healthcare product, and then flies out.
I can immediately see the friction here. If I am the legacy local guy in Tampa, and suddenly this newly acquired regional expert from Accession swoops into my territory to pitch a hospital, who gets the commission?
Exactly the problem. Who manages the client relationship day to day?
You are essentially smashing two completely different compensation and management structures together.
Which is why integrations are so perilous. Management's stated goal here is to take the best of both.
Meaning what?
Maintaining the local hustle while injecting the high-level industry specialization of Accession. They are trying to create a hybrid operating rhythm.
Where the local agent originates the relationship and the regional specialist closes the complex technical sale.
That's the dream, yes.
That sounds great on a PowerPoint slide, but forcing 5,500 people to share their commission pools and change their CRM software is brutal.
It is painful, expensive work.
So why go through that agony? The sources point to one specific division of Accession as the crown jewel. 180 intermediaries.
Yes, 180.
And the strategic reason for buying them comes down to a single word: casualty.
Brown & Brown took 180 intermediaries and folded them directly into their newly created specialty distribution segment. And this fundamentally altered the firm's revenue weighting.
In a good way.
In a necessary way. Historically, Brown & Brown's specialty division was heavily exposed to catastrophe property insurance, what the industry calls sea-daddy property.
Right. Wind, hail, hurricane, earthquake.
Exactly. High-risk property coverage.
Which is incredibly volatile. If a series of hurricanes hits, premiums skyrocket, and the broker's commission checks get massive. But if the weather is calm and capital floods the market, rates plummet. It is a roller coaster.
Casualty lines, on the other hand, cover liability, workers' compensation, professional errors and omissions, general liability for slip and fall accidents.
And those aren't tied to the weather.
Right. These risks are not dependent on the weather. Lawsuits happen in sunshine and in rain, so casualty pricing is far more stable over time.
So by acquiring 180 and injecting a massive volume of casualty business into their portfolio, Brown & Brown is intentionally dampening their exposure to the extreme peaks and valleys of the property market.
They are buying stability.
So they took on billions in debt and integrated 5,500 people, essentially, to smooth out their revenue curve, to create a more predictable business.
That is the strategic rationale, yes.
But the irony is, the immediate result of this integration has been anything but predictable. Let's look at the financial realities, because Q1 2026 is where the paradox really crystallizes.
Right, the Q1 numbers.
The headline growth of 35.4% was driven entirely by the acquired revenue from Accession, but Wall Street dissects growth into two categories, right?
Yes, acquired growth and organic growth.
And organic growth measures how much your pre-existing core business actually expanded.
And for Brown & Brown in Q1, organic growth was exactly 0.0% flat.
A growth stock with 0% core growth. That is the number that triggered the sell-off to $57.46.
It terrified the market.
But the report argues that 0% number is heavily distorted by some very specific one-off headwinds. Let's start with the weather again. We established they don't pay claims, but somehow a lack of flood claims created a massive revenue drag.
This ties back to their WNFIC flood business. Remember, they act as an administrator for FEMA.
Right.
While they don't pay the claims, they do earn administrative fees for processing those claims. In the first quarter of the prior year, there were significant flooding events. Brown & Brown deployed their adjusters, processed the claims for the government, and earned an extra $12 million in processing revenue.
So severe weather is actually a double-edged sword for them. It drives up property rates, which boosts commissions, but the actual act of processing the disaster yields administrative cash.
Exactly. In Q1 of 2026, the weather was benign. Very few floods meant very few claims to process.
Which resulted in a $12 million year-over-year revenue vacuum.
Yes. And that single $12 million absence dragged the entire specialty distribution segment's organic growth metric down by 300 basis points.
Let's clarify that jargon for a moment for anyone listening. 100 basis points is just 1%.
Right.
So a 300 basis point drag means the segment's growth looked 3% worse purely because there wasn't a flood. That is fascinating.
It shows how fragile short-term metrics can be.
So the top-line organic growth is stalled, partially due to calm weather. But what about profitability? If revenue is flat, how did the bottom line look?
This is where the underlying operational strength begins to show. Their adjusted EBITDAC, which stands for earnings before interest, taxes, depreciation, amortization, and the change in estimated acquisition earnout payables.
That is a mouthful.
It is. But that metric grew 36.6% to $731 million.
Wow.
And more importantly, the margin expanded by 40 basis points to 38.5%.
Meaning for every dollar of revenue that comes in the door, they are keeping 38.5 cents as core operating profit.
Exactly.
A 40 basis point increase means they are keeping an extra nearly half a cent on every dollar compared to last year. That sounds incredibly healthy. But wait, the sources also explicitly state that the Accession integration negatively impacted margins by 200 basis points.
Right.
How can overall margins expand by 40 basis points if the new acquisition dragged them down by a full 2%?
It is a mathematical illusion caused by seasonality.
Walk me through that.
Legacy Brown & Brown has a highly concentrated seasonal revenue spike in the first quarter. Their employee benefits division sees a massive wave of policy renewals on January 1st.
Okay, so a huge influx of cash right at the start of the year.
Because all that revenue floods in during Q1 against relatively fixed costs, Legacy Brown & Brown's Q1 margins are always disproportionately massive, often well over 40%.
I see. And Accession doesn't have that same January 1st spike.
No. Accession's revenue is much more evenly distributed throughout the calendar year. Their Q1 margins look like a normal quarter.
So when you consolidate the two companies' financial statements, Accession's normal margin dilutes Legacy Brown & Brown's superpowered Q1 margin.
Exactly. That consolidation math created a 200 basis point statistical drag.
So management is looking at investors and saying, if you strip out the statistical dilution of blending a flat quarter with a spike quarter, our underlying expenses are dropping and our true margins are actually expanding beautifully.
They are pointing to very disciplined expense management. They are consolidating real estate, renegotiating vendor contracts with their new, larger scale, and streamlining administrative overhead.
But that doesn't mean the integration is cheap. The Q1 report details $113 million absorbed in outright acquisition and integration costs.
It is a massive upfront cost.
That is $113 million flowing out the door to integration consultants, IT specialists migrating data, lawyers, and severance packages for redundant middle management.
And that cash drain slightly depressed their operating cash flow conversion ratio from 15% to 14%.
It is the unavoidable toll of a $9.6 billion merger.
But management is projecting that as these systems finally unify over the next year, they will realize $30 million to $40 million in annualized synergy savings.
But Wall Street is impatient. They see 0% organic growth today. Management realizes the market is panicking over this metric, so in this quarter, they introduced a brand new non-GAAP financial metric to try and change the narrative.
Yes, they did.
They called it organic revenue with contingents, and under this new customized metric, they claim they actually grew by 2.2%.
When a company suddenly introduces a bespoke reporting metric during a tough quarter, analysts immediately raise their eyebrows. It requires intense scrutiny.
Absolutely. We need to define what contingent commissions are to understand why the market is pushing back.
Right.
Let's define the mechanics, because it's not a standard sales commission.
Right. A standard commission is front end. You place a $100,000 policy, you take a 10% commission, you earn $10,000 today.
Simple enough.
A contingent commission is a back-end profit-sharing bonus. Let's say Brown & Brown places a portfolio of 1,000 commercial auto policies with a major carrier.
Okay.
At the beginning of the year, the carrier says, if the loss ratio on this specific portfolio stays below 60%, meaning we pay out less than 60 cents in claims for every dollar of premium you brought us, we will share a percentage of our underwriting profit with you as a bonus at the end of the year.
So it is an incentive structure designed to make the broker act like an underwriter. The carrier is rewarding Brown & Brown for bringing them safe, well-managed clients who don't file a lot of claims, rather than just indiscriminately shoveling any risk through the door just to get a front-end commission.
Exactly. It rewards long-term portfolio performance.
Yeah.
And in Q1 of 2026, Brown & Brown's contingent commissions exploded. They surged by $52 million to hit $97 million for the quarter.
Wow. So they brought the carriers incredibly profitable business, and the carriers wrote them massive bonus checks.
Correct.
So management's argument is, look at these massive performance bonuses. If you include these as part of our core growth, our organic growth is 2.2%, not zero. Stop panicking.
That is their pitch.
But if I am a cynical Wall Street analyst, I am looking at this like a college student who just failed their final exam, but points out they received a $50 gift card for having perfect attendance last semester.
But that is precisely why the market discounted the new metric. Contingent commissions are inherently backward-looking. A massive bonus check received in Q1 2026 is a reward for the low loss ratios on policies that were written and managed throughout 2024 and 2025.
It is a lagging indicator. It tells you nothing about how much new business the brokers are selling today.
The market views organic revenue with contingents as a cosmetic attempt to mask a stalling current sales engine.
If your core sales engine is stalling, and you can't rely on accounting metrics to soothe the market, you really only have two operational levers to pull. Brutally cut your workforce to save cash, or drastically increase the efficiency of the workforce you have.
And the report makes it incredibly clear that Brown & Brown has chosen the efficiency route. They are leveraging an AI pyramid strategy.
This is where we shift from immediate financial noise to long-term structural advantage.
Yes, the deployment of artificial intelligence at Brown & Brown isn't a reactive panic move. The sources emphasize that this current AI push was only made possible by a grueling 10-year foundational journey of platform rationalization and data standardization.
Let's talk about the reality of data standardization, because it sounds like a boring IT project. But in the insurance brokerage world, it is an absolute nightmare.
Oh, it's incredibly difficult.
Brown & Brown grew over 85 years by acquiring hundreds and hundreds of smaller local agencies.
Imagine the data environment of a company built through decades of acquisitions. You buy an agency in Ohio, and they store all their client data on an outdated proprietary AS400 server.
Right.
You buy an agency in Texas, and they manage their multi-million-dollar book of business entirely on chaotic, color-coded Excel spreadsheets.
So like a disaster.
You buy a third agency, and they use a modern cloud CRM, but they categorize a commercial property completely differently than the other two.
It is a digital Tower of Babel.
Yeah.
If you try to plug a cutting-edge large language model into that mess, the AI will just hallucinate and spit out absolute garbage.
Before you can utilize AI, you must have pristine, structured data. Brown & Brown spent a decade forcing every single acquired agency to migrate off their legacy systems and onto a unified, standardized technology platform.
Wow, 10 years of just laying the plumbing.
They forced everyone to speak the exact same data language. Only after that plumbing was perfected could they launch the AI pyramid strategy.
They operate what the report calls a fail-fast incubator model for cloud-native solutions. They are rapidly testing AI workflows in small pilot programs.
If it hallucinates or fails to generate ROI, they kill it instantly.
But if it works, because all 700 global locations are on the same data architecture, they can instantly scale that AI tool to every broker in the company overnight.
The speed of deployment is a huge competitive advantage.
And the specific efficiency gains they are measuring are staggering. Let's look at submission automation.
The submission process in commercial insurance is brutally administrative. Let's say a broker in the specialty distribution segment is trying to place coverage for a mid-sized manufacturing company.
Okay, picture that.
The client sends over a 150-page PDF containing property schedules, vehicle VIN numbers, past claims history, and payroll data.
Historically, a junior broker or an account manager has to sit there for hours, manually retyping all that PDF data into standardized industry forms, and then manually logging into 5 different carrier portals to re-enter the exact same data, just to request a quote.
It is mind-numbing data entry.
The report states that Brown & Brown is now utilizing AI agents to automate 25% of that end-to-end submission process in the specialty segment.
The AI ingests the messy PDF, understands the context, automatically extracts the relevant data points, populates the standardized forms, and interfaces directly with the carrier APIs.
And then there is direct bill automation. When a carrier bills a client directly, the broker still has to track that payment to ensure they get their commission.
Right, which used to be another highly manual process.
The AI is now interfacing with the carrier billing portals, automatically extracting the payment status, validating it against the internal ledger, and filing the reconciliation. The report quantified this. That single automation saves 50,000 hours annually.
Think about the operational leverage of erasing 50,000 hours of manual labor.
It's massive.
But it is crucial to understand management's philosophy here. They are not using AI to fire their 23,000 teammates. They explicitly view AI as an enabler and accelerator.
It is the Iron Man suit.
The Iron Man suit.
Yeah. Tony Stark is brilliant. He has the relationships, the strategic vision, the industry knowledge. But if you send him into a war zone in a business suit, he gets crushed. You put him in the armor.
I see.
The AI is the armor. It handles the brute force data processing, it flags anomalies at superhuman speed, and it handles the repetitive administrative tasks.
By stripping away the administrative burden, the broker is freed up to do the one thing technology cannot replicate. Sit across the table from a CFO, understand the nuanced fears and strategic goals of their business, and build trust.
AI disintermediates tasks, not trust.
Differacy.
When a company is squeezing 50,000 hours of efficiency out of their operations, they inherently believe their future cash flow is going to be massive.
Right.
And that brings us to governance and capital allocation.
How leadership spends the company's cash is the ultimate lie detector test for how they view the health of the business.
Which brings us to the $250 million accelerated share repurchase, or ASR, executed in February 2026.
The stock had cratered to that 52-week low of $57.46. Management looked at that price and essentially backed up the truck.
But an ASR is not your standard slow and steady corporate stock buyback program, is it?
Not at all. In a standard open market buyback, a company might quietly buy a few thousand shares a day over the course of a year, trying not to disrupt the stock price.
Right.
An ASR is a massive, immediate, blunt instrument. Brown and Brown went to an investment bank, in this case Bank of America. They handed Bank of America $250 million in cash up front.
Okay.
Bank of America then went into the market, borrowed 3.57 million shares of BRO stock from institutional investors, and handed those shares to Brown and Brown immediately.
So Brown and Brown retires those 3.57 million shares instantly, permanently reducing the supply of stock on the market and artificially boosting their earnings per share.
Yes.
And then Bank of America is on the hook to slowly buy shares on the open market over the next few months to return the borrowed shares to the institutions.
Exactly. It provides instant gratification to the balance sheet and sends a deafening signal to the market.
But I have to push back hard on this. I understand buying your stock when it's cheap, but look at the mechanics of how they funded this.
The funding source is definitely controversial.
They didn't just use cash sitting in a checking account. The report notes they funded the $250 million ASR by drawing $225 million from their revolving credit facility.
Yeah, they tapped the revolver.
They already took on massive debt to buy Accession, bringing total corporate debt to $7.82 billion. And to buy back their own stock, they literally borrowed more money on their corporate credit card. Isn't that reckless?
It is a highly aggressive, deeply leveraged maneuver, and it is exactly why the market punished them. Institutional investors looked at a balance sheet with nearly $8 billion in debt, looked at an organic growth rate that had flatlined at 0%, and saw management borrowing even more money to engineer a stock buyback.
It looked like hubris.
So why did management pull the trigger? What do they see that the market is missing?
What do they see?
They see the underlying cash generation engine. You only draw on a revolver to buy your own equity if you possess absolute unwavering conviction in your operational cash flow.
Despite the 0% organic growth noise, Brown and Brown generated $262 million in operating cash flow in the first quarter alone.
They are generating so much pure cash every 90 days that they can comfortably service the massive debt load, fund internal operations, and still have cash left over.
They looked at a $57 stock price and determined that the return on investment of buying their own shares was far higher than the interest rate they were paying on the revolver.
It establishes what analysts call a value play floor.
By stepping in with $250 million in borrowed capital, management is drawing a line in the sand.
They are telling institutional short sellers, we believe this stock is severely mispriced and we will leverage our balance sheet to defend it. Furthermore, they backed up this confidence by raising their dividend.
The 33rd consecutive year of dividend hikes. You don't raise the cash payout to shareholders for 3 decades straight if you are secretly worried about making payroll or servicing your debt covenants.
There is another detail in the governance section that speaks to the integrity of the management team. The executive compensation model is strictly pay for performance.
Right. The board of directors didn't just hand out participation trophies because the executives worked really hard on the Accession integration. The cash incentive plan has a strict payout curve based on specific metrics.
Because organic growth hit 0%, the formula was triggered.
It resulted in a literal zero payout for that specific incentive metric for the executive leadership team.
The executives felt the pain of the stalled growth engine directly in their own bank accounts.
That alignment between management and shareholders is critical.
Yeah.
But even if management is aligned, and even if they're confident enough to buy back stock on margin, there are massive structural storms on the horizon that completely validate the market's skepticism. We have to dive into the risks. Let's look at the weather again, but this time, not the lack of floods, but the pricing of catastrophe risk.
We need to distinguish between two completely different regulatory environments in commercial property insurance: the admitted market and the excess and surplus, or E&S market.
Let's define those, because the report notes a massive divergence between the two.
The admitted market is highly regulated. Carriers operating in the admitted market must file their rates and policy forms with the State Department of Insurance.
So it's very strict.
Yes. If a carrier in Florida wants to raise commercial property rates by 10%, they have to ask the state for permission, and the state can say no. Furthermore, admitted carriers are backed by state guarantee funds. If the carrier goes bankrupt, the state steps in to pay the claims.
It is a rigid, slow-moving market, but it offers immense stability for the insured. The report notes that admitted P&C rates are currently stable, flat to up 5%. But then you have the E&S market.
The excess and surplus market is the release valve for risks that the admitted market refuses to touch. Coastal properties, earthquake zones, highly complex manufacturing facilities.
Okay.
The E&S market operates with freedom of rate and form. They do not have to ask the state for permission to change their prices. If a massive hurricane wipes out Miami, E&S carriers can triple their rates the very next morning.
It is the Wild West, true supply and demand pricing. And because Brown's legacy specialty distribution segment was historically heavily weighted toward placing CIT property, catastrophe property like wind and quake, they operate heavily in the E&S market.
And right now, the E&S market for CI property is experiencing a massive cyclical collapse. Rates are plunging 15 to 35%.
Why the sudden collapse?
Capital inflows. Over the last few years, a string of severe natural disasters caused property rates to skyrocket. When rates hit all-time highs, it attracted massive amounts of alternative capital.
Like who?
Hedge funds and pension funds poured billions of dollars into the reinsurance market and catastrophe bonds, seeking those high yields. This massive influx of fresh capital replenished carrier capacity. When supply outstrips demand, prices fall.
And when E&S rates drop 35%, Brown & Brown's commissions take a direct hit. The report notes an interesting behavioral economic factor here. You would think that if a client's property insurance suddenly costs 35% less, they might take those savings and buy higher limits, or add additional coverages like cyber liability, keeping the broker's total commission relatively flat.
But the report clearly states that most clients are simply pocketing the premium savings. They are enjoying the budget relief.
So the total premium pool shrinks rapidly, and the broker's percentage of that pool yields a much smaller check. This structural rate plunge is the primary macroeconomic force dragging their core organic growth down to zero.
So you have a cyclical rate collapse eroding your top line. That is a tough break, but it is just the nature of the insurance cycle.
The market can eventually forgive a cyclical downturn. What the market absolutely cannot stomach is internal collapse. And that brings us to the litigation, the Howden poaching crisis.
This is the crisis that truly threatened the ownership culture narrative of Brown & Brown. Howden is a rapidly growing, highly aggressive rival brokerage firm backed by immense private equity capital. They executed a coordinated surgical raid on Brown & Brown's talent, successfully poaching 275 employees.
275 people. This wasn't a couple of disgruntled mid-level managers deciding to start their own boutique firm. To orchestrate the defection of nearly 300 employees requires massive logistical planning, immense signing bonuses, and a deliberate strategy to cripple a competitor's specific divisions.
In the commercial insurance brokerage industry, the ultimate asset is the relationship between the broker and the client. When a top-tier producer leaves a firm, the client almost always follows the producer, regardless of the corporate logo on the door. The financial fallout of this raid was brutal. The report quantifies it as a $31 million loss in annualized customer revenue.
$31 million walking out the door. The report notes that this specific loss created a $10 million drag on Q1 organic growth alone. Brown & Brown obviously didn't just let this happen. They deployed the lawyers. They secured a temporary restraining order, or TRO, in a Massachusetts court to enforce their restrictive covenants.
Let's unpack the legal mechanics of that. In a relationship-based industry, employment contracts are heavily bound by restrictive covenants, primarily non-solicitation agreements.
Right.
You generally cannot force an employee to stay through a non-compete, but a non-solicit dictates that if you leave, you cannot proactively call, email, or attempt to move any of the clients you serviced at Brown & Brown for a specific period, usually 12 to 18 months.
So Brown & Brown goes to a judge in Massachusetts and says, Howden didn't just hire our people. They are actively aiding and abetting the breach of these non-solicit agreements by moving our clients over.
The judge grants the TRO, legally freezing the ex-employees from touching those specific accounts while the lawsuit plays out.
The TRO stops the immediate bleeding, but the damage to the firm's reputation and internal morale is done. And it raises a critical question. How does a raid of this magnitude succeed at a firm that prides itself on culture? Brown & Brown is famous for an ownership structure where teammates own nearly 20% of the firm's stock.
They sell it as a meritocracy. You build your book of business, you earn stock, you own a piece of the rock. Why would 275 people abandon that equity?
If you connect the macroeconomic environment to the microeconomic reality of a broker, the vulnerability becomes obvious. We established that E&S property rates are plunging 35%. That means the overall commission pools are shrinking.
When commission pools shrink and the firm's organic growth hits 0%, the performance-based bonuses dry up. We saw the executives get zeroed out. The rank-and-file producers are feeling that exact same compensation compression.
So their W-2s are shrinking because the market cycle turned against them. Yeah. And suddenly, a massively funded rival like Howden knocks on the door and says, "We know your commissions are down. We will buy out your unvested Brown& Brown stock. We will guarantee your base salary for 3 years, and here is a massive upfront signing bonus in cash."
Exactly. When compensation compresses during a cyclical downturn, an ownership culture is severely tested. Add to this the reality of the post-pandemic hybrid work environment.
The at-will employment model is incredibly fragile when employees are less tethered to a physical office and the daily camaraderie of a culture. They are isolated at home, their paychecks are shrinking, and a recruiter offers them a mountain of cash.
Culture alone cannot serve as an absolute shield against a competitor willing to aggressively outspend you.
That is the dark reality of a human capital business. Plunging E&S rates, nearly $8 billion in debt, zero organic growth, and rivals buying hundreds of your best revenue generators. It paints a bleak picture. But the strategic report concludes with a definitive, almost aggressive rebound thesis.
The analysts are looking at all this wreckage and assigning Brown& Brown a core compounder value play rating.
They are arguing that the current 52-week low is a cyclical valley, a temporary trough, rather than a structural failure of the company's foundation.
They are modeling a very specific, mathematically driven recovery in the second half of 2026.
Walk us through the specific mechanics of that H2 recovery. Why does the math suddenly flip from punishing them to rewarding them in Q3 and Q4?
It comes down to two highly quantifiable factors: seasonality and accounting rules. First, let's look at the seasonality of the CAT property headwinds. Brown& Brown places the vast majority of its wind, hurricane, and earthquake property policies in the first and second quarters ahead of the Atlantic hurricane season.
Right, you buy your hurricane insurance in May, not in November.
Because the bulk of those renewals happen in H1, that is when they feel the most severe impact of the 15 to 35% rate plunge. By the time they reach the third and fourth quarters, they are placing significantly less of that specific CAT property business. Therefore, the mathematical drag on their total revenue naturally dissipates. The headwind simply dies down.
The weather stops hurting them. But a lack of a headwind isn't the same as a tailwind. What drives the actual growth in H2?
The second factor is the one-year anniversary of the Accession acquisition. Remember, under standard accounting rules, when you acquire a company, their revenue does not count toward your organic growth metric for the first 12 months. It is classified purely as acquired growth.
But the Accession deal closed in August of 2025.
Which means in August of 2026, the calendar flips. The massive revenue stream from Accession, specifically that highly stable, growing 180 casualty business, suddenly rolls into the organic growth calculation.
And because casualty rates, the liability of the workers' comp, are actually experiencing slight rate increases in the primary layers, that specific book of business is growing.
Precisely. The inclusion of that massive, stable casualty portfolio will provide a powerful mathematical tailwind. It will artificially lift the organic growth metric that the market is currently panicking over. The narrative will shift overnight from stalled core business to accelerating organic growth, even if the underlying operations haven't drastically changed.
It is a masterclass in the mechanics of a transition. When you synthesize the entire picture, you see a company absorbing immense short-term pain. They are paying the massive $113 million integration toll for Accession. They are taking the cyclical hit from the plunging property markets. They are fighting off aggressive, well-funded poachers in court. And they're doing all of this while simultaneously wiring up an AI infrastructure that is already erasing 50,000 hours of manual labor.
They are paying the price today to transform into an $8 billion tech-enabled behemoth tomorrow. Management sees the H2 math coming, which is why they were willing to borrow $250 million to buy their stock at $57. They believe the market is incredibly short-sighted.
Which leads us with a fascinating multi-billion-dollar question to ponder. We spent a lot of time analyzing the AI pyramid strategy. The 10 years of data standardization, the automated submissions, the direct bill bots. But this entire deep dive also proved that insurance brokerage, at its absolute core, is a relationship business. It relies on humans trusting other humans to protect their balance sheets.
The human element remains the ultimate variable.
Exactly. So here's the question. If a private equity-backed competitor can simply write a massive check and legally acquire 275 of your best, most trusted relationship managers overnight, how deep is your technological moat, really? Does the future of this industry belong to the firm with the cleanest data, the most efficient AI agents, and the ultimate operational scale? Or does it simply belong to the firm willing to write the biggest checks to poach the top talent when times get tough?
That is the defining tension of the modern brokerage industry. Technology can build an Iron Man suit, but it cannot stop Tony Stark from taking off the suit and walking out the door.
Risk defined, portfolio protected.